Today, fall markets fall. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, I've been talking about the Fed put for some time now, and I think the markets are finally getting it. Consider this. The US Central Bank sees financial market pain as part of the process to tackle inflation, a thought that investors really haven't known in more than a generation. In fact, Powell said this week financial conditions overall have tightened significantly. Broadly across financial conditions, you're seeing that, and that's what we need. The comments amount to Powell effectively endorsing a sell-off in US equities that took the S&P 500 to the edge of a bear market, which means, of course, a 20% decline from a high last week. Another component of the tightening in financial conditions has been higher premiums on corporate bonds, and mortgage rates have also climbed, and the dollar has appreciated. So why does the Fed need to see such developments? Well, simply because all of these moves will serve to dampen demand. Sliding stocks will dent household and business confidence, encouraging them to rein in spending. Higher borrowing costs will similarly undermine willingness to buy things like homes and cars, commercial centres, a company's upgraded computer network, whatever the case may be. And by dampening demand, the Fed can bring these things closer to where supplies are, as Powell explained, and that in turn will bring down price pressures. For anyone who invests in stocks and bonds, these comments effectively amount to Powell saying that the famous Fed put is gone. In other words, the central bank won't save markets by altering to an easier policy stance, well, at least for now. Remember, in stocks, a put is a contract that allows you to sell your holding at a certain price. A Fed put, in which the central bank alters policy to prop up equity markets after a sharp decline, is something many investors have been betting on. But given the Fed's focus on controlling inflation, Powell discussed earlier this week and warned that officials seek clear and convincing evidence that price pressures are retreating, so don't count on a Fed put anytime soon. And on that theme, while Kansas City Fed President Esther George on Thursday acknowledged equities were having a rough week, she said the market rout was no surprise in the light of the central bank's repeated caution that it will continue raising interest rates to cool the hottest inflation decades. What we're looking for is the transmission of our policy through markets' understandings that tightening should be expected, George said recently. That's just a day after weak quarterly earnings from major retailers contributed to a sell-off in stocks. It's not aimed at the equity market in particular, but it is one of the avenues through which tighter financial conditions would emerge. Falling equities assist the Fed's goal of slowing growth because of the wealth effect in which investors curtail some spending in response to market drops. In fact, JP Morgan economists cut their US economic forecast for this year and next, citing in part the decline in stocks. Each $1 of lost financial wealth translates into a drop of spending of $2 or $3 over the course of a year, they estimated. What we've seen so far remains consistent with the Fed's objectives in terms of tightening financial conditions to slow growth and realign demand with depressed supply, said Robert Dent, a Nomura Securities economist. The market is beginning to come to terms with a Fed that is determined to bring inflation lower at all costs. Most Fed officials have embraced raising rates to a neutral setting, which neither speeds up nor slows down the economy this year, and the FOMC estimated that to be at 2.4% in quarterly forecasts, last updated in March. Powell and other Fed officials have said they are willing to go well past that level if necessary to cool prices, though the pace of increases could slow. You could kind of read the Fed's approach as almost endorsing the drop in equity prices and asset prices more broadly, Johannes Golderman of Capital Economics said on Thursday, adding that in past hiking cycles, the Fed used a gradual approach to minimize the impact on financial conditions. But the S&P 500 is now knocking on bear territory, and the Nasdaq is already there. Obviously, there are some volatile days in the market, Powell said on Tuesday in a Wall Street Journal moderated event, explaining he was pleased markets have priced in future Fed hikes. It's been good to see financial markets reacting in advance based on the way we're speaking about the economy and the consequences, he said. The stock market isn't the only goal for Fed tightening, though. Higher rates for home mortgages and vehicles reduce demand in those markets where supplies have been short, and a stronger dollar has the effect of cutting export demand for US manufacturers and trimming import prices. All of these moves will serve to dampen demand. And sliding stocks will dent household and business confidence, encouraging them to rein in spending. And by dampening demand, the Fed can bring things closer to where supplies are, Powell explained, and that in turn will bring down price pressures. Not that policymakers are actively targeting S&P 500 levels, Powell made it clear that the ultimate indicator will set policy is consumer prices themselves. What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that. That has touched off what amounts to a crisis response of 0.5 percentage point rate increases and a pledge this week by Powell to raise rates as high as needed to bring inflation down. And to do so means slowing the economy enough to trim the excess demand the Fed officials feel is driving prices higher, and in the current situation causing companies to eliminate hiring plans that have led to record levels of job openings and wage pressures as they compete for workers. Some tech firms have already announced hiring freezes as a result of their dimmed outlooks and falling stock prices, a sign the Fed's hoped-for narrative has begun to play out. Now, of course, in the best case, inflation will fall before firms reach the point of actual layoffs, but getting there still means a blow to corporate earnings, a key component of stock pricing, as companies reset sales and growth expectations. The sell-off in equity markets may ultimately be as important as the rise in interest rates in moderating demands, arguing that higher interest rates may not on their own be enough, for example, to cool the housing market. Some of the work of tighter financial conditions will come through the now 18% decline in equity prices. If the objective is to reduce job openings, it's easier to see a link between equity prices, corporate sentiment, and hiring plans than it is between interest rates and job openings, the Citi team wrote. But a key takeaway is the US central bank sees financial market pain as part of that process, and that's a framework investors haven't known in more than a generation. Now, on Thursday, the Dow fell, leaving the broader market on the precipice of an 8 straight weekly loss, as early day attempts to claw recent losses proved short-lived, and amid a meltdown in tech. The Dow Jones Industrial Average slipped 0.75% to 31,252. The Nasdaq fell 0.26% to 11,388, and the S&P 500 fell 0.58% to 3,900, to take losses to about 18% since its recent peak, just shy of that 20% decline into bear market territory. Technology stocks, which were briefly in the green, came under fire as expectations for aggressive Federal Reserve rate hikes continue to weigh on investor sentiment. Apple led the decline in big tech, down 2.46% to 137.35. Even some on Wall Street reassessed their outlook on iPhone demand. Bank of America raised its estimates on iPhone sales to 237 million units from 231 million units for Apple's 2023 fiscal year, after considering that prior iPhone estimates may have been too conservative. Cisco was also a big drag on the market, plunging about 14% to 41.72 after the network company reported quarterly results and guidance that fell short of Wall Street estimates, owing to the impact of China lockdowns. Although the lockdown is expected to be lifted on June the 1st, it remains uncertain if improvements can be seen in the short term, considering ports and airports are expected to be congested as nearly all manufacturers will compete for the capacity to get their products shipped, Credit Suisse said in a note. Harley-Davidson reversed about 9% after suspending most vehicle assembly and shipments for 2 weeks after a supplier was caught up in a regulatory compliance matter. It closed at 32.43. And consumer staples, a defensive corner of the market, also pushed the broader market lower, with the latter pressurised by losses at Clorox, Philip Morris International, and Molson Coors Brewing. Consumer discretionary stocks cut gains to end the day just above the flat line as Expedia, Caesars Entertainment, and Booking Holdings gave up some of their gains, and Tesla ended the day flat after its intraday rally cooled after Wedbush slashed its price on the stock, forecasting a China-led dip in deliveries for the second quarter. In fact, Wedbush cut its price target on Tesla to $1,000 from $1,400, pointing to the Shanghai lockdowns, which have been an epic disaster and are expected to modestly impact delivery in the second quarter, the research firm said. And the economy front did little to soften fears of slowing economic growth ahead after jobless claims increased by more than expected to 218,000 compared with the 200,000 expected. Continued claims for state benefits did drop to 1.32 million in the week ended May the 7th. That's the lowest since 1969. And while the continuing claims figures underscores a still solid labour market, a sustained increase in initial applications could signal some softening. As the Federal Reserve tightens monetary policy more aggressively to rein in rampant inflation, higher interest rates are expected to reduce the demand for labour. And in other economic news, the Philadelphia Fed released their May 2022 Manufacturing Business Outlook Survey based on data from the 9th to the 16th of May. The survey's General Activity Index declined, while the indicators for new orders and shipments rose. The Employment Index decreased, and the price indices remained elevated but edged down. The survey's future indices remained positive but reflected muted optimism for growth over the next 6 months. In fact, their diffusion index for current activity fell 15 points to 2.6 in May. That's the lowest reading in 2 years. And most firms at 57% reported no change in current activity this month, while the share of firms reporting increases at 22% narrowly exceeded the share reporting decreases at 20%. The index for new orders rose 4 points to a reading of 22.1, and the current shipments index climbed 16 points to 35.3, its highest reading since October 2020. The firms continue to report increases in prices for inputs and their own goods. The prices paid diffusion index, which hit a near 43-year high last month, declines just 6 points to 78.9. More than 81% of firms reported increases in input prices and 17% reported no change. The current prices received index edged down 3 points to 51.7, and nearly 52% of the firms reported increases in the prices of their own goods, and 47% reported no change. The diffusion index for future general activity declined from a reading of 8.2 in April to 2.5 in May. That's the lowest reading in more than 13 years. Over 24% of firms expect growth over the next 6 months, down from 37% last month. 22% expects a decrease in activity, down from 29%, and 46% expect no change, up from 31%. The future new orders index climbed 12 points to 16.1, and the future shipments index edged up 2 points to 32.1. And the future employment index decreased 10 points to 29.2. About 1/3 of firms expect to increase employment. The future capital expenditures index fell 10 points to 9.6. That's the lowest reading since February 2016, suggesting less widespread expectations for capital spending. And the US Federal Reserve will lift interest rates higher by the end of this year than anticipated just a month ago, keeping alive already significant risks of a recession, according to a Reuters poll that's just published. While US inflation, running at a 4-decade high, may have peaked in March, the Fed's 2% target is still far out of reach, as disruptions to global supply chains continue to keep price rises elevated. The poll in May 12 to 18 showed a near unanimous set of forecasts for a 50 basis point hike in the Fed funds rate, currently set at 0.75% to 1% at the June policy meeting, following a similar move earlier this month. One forecaster anticipated a hike of 75 basis points, and the Fed's expected to hike another 50 basis points in July, according to 54 of 89 economists, before slowing to 25 basis point hikes for the remaining meetings this year. But 18 respondents predicted another half percentage point rise in September too. A majority of poll respondents now expect the Fed funds rate to be at 2.5 to 2.75% or higher by the end of 2022. That's 6 months earlier than predicted in the previous poll, and roughly in line with market expectations for a year-end rate of 2.75 to 3%. Now that would bring it above the neutral level that neither stimulates nor restricts activity, estimated, as I said earlier, at 2.4%. The pressing goal is to bring policy rates to neutral before stepping back to judge the impact, Sal Guattari, senior economist at BMO, wrote in the note. The Fed can only hope that inflation pressures stemming from high commodity prices and the pandemic's impact on labour and material supplies will reverse soon. Meanwhile, the poll showed a median 40% probability of a US recession over the next 2 years, with a 1 in 4 chance of that happening in the coming year. Those probabilities were steady compared with the last survey. And forecasts for the unemployment rate remained optimistic around 3.5% this year and next, before picking up to 3.7% in 2024. But more than 80% of respondents said that over the coming 2 years, it was more likely that unemployment would be higher than they are currently expected than lower. The only realistic way to break the wage price spiral is to push up the unemployment rate. If the Fed does not do this by accident, they will have to do it by design, said Philip Murray, senior US strategist at Rabobank. A recession is the inevitable outcome. And with that ringing in your ears, expect more falls in the markets over the next few weeks. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.